Why should investors consider investing in Singapore equities for the long term?
One has to distinguish between trading and investing, where the former requires actively timing the markets, while the latter is all about being in the market or time in the markets. For the Singapore equity market, Amundi believes in active management, and hence time in the markets is relatively more important than timing the markets. We are not traders and believe that share prices of fundamentally strong companies will rise through time. In general, since 1999 to August 2018, the Straits Times Index had risen 150%. Of course, along the way the market has its fair share of ups and downs, including the 2011 European debt crisis, and the Fed quantitative tightening and the Chinese shadow banking issues in 2015. Now, these two episodes were short-lived as the market quickly recovered at the end of 2011 and 2015 respectively. In general, timing to trade in the market has proven to generate inconsistent returns compared to a buy-and-watch strategy. Singapore has got strong fundamentals, including a stable political environment, a transparent legal system, strong corporate governance, and positive and growing current account, which emboldens investors' confidence. Many of the corporates in Singapore have a solid foundation, some of which have specialized market niche, which makes it appealing for investors across the globe, not just for Singapore investors. In addition, the beauty of investing in the Singapore equity market is that earnings is not solely dependent on this island state. In fact, most of the corporates generate much of their earnings from abroad. Using the 30 constituents of the STI, 60% of the sales are derived from outside Singapore, ranging from China to Australia to even as far as Brazil and the USA. In general, time in the market generates more consistent return over the medium to longer term.
How does Amundi achieve long-term capital growth in its Amundi Singapore Dividend Growth Fund?
The Amundi Singapore Dividend Growth Fund has twin objectives. It is to provide consistent dividend for our investors and at the same time generate positive capital growth. Since its inception in 2003, the fund had consistently paid out 5% of its net asset value as dividends every year, while capital had also risen from $1 to $1.90 today. The two factors that has driven our strong performance: one, approach, the other one is platform. On approach, we adopt a total return strategy combining a strong bottom-up quantitative and qualitative approach. What really sets us apart is our portfolio managers, the decision makers themselves. They are close to the ground with the head office and operations of each company that we invest in. We have a concentrated portfolio of 25 to 30 securities, allowing us to meet the company management on a regular basis. As a result, our decision makers have thorough and intimate knowledge of each company, which is critical in evaluating companies with strong fundamentals that tend to perform well in both bearish and bullish scenarios. What are the criteria that we look at before we start investing in a company? 1. Quality of management, corporate governance, and transparency. 2. Above average growth potential. 3. Stable balance sheet and reasonable valuation. Our proven approach has allowed us to outperform our peer group average since its inception. The second factor is platform. Our Singapore investment operations are part of Amundi's emerging markets platform that manages around 40 billion euros in assets under management globally. This strong integrated network means that we have an efficient platform for cross-pollination of ideas and sharing of macro and fundamental research. Amundi is also Europe's largest asset manager, which means we can leverage off these specialist skills and the primary research across our 6 investment hubs globally. This helps Amundi stand out from our local peers, as many of our Singapore-listed companies derive their earnings from outside Singapore, and we are able to tap on our talent pool around the world for better insight and scrutiny into the overseas operations of these companies.
What are the ways that investors can participate in growth opportunities?
Investors can capitalize on the growth opportunities by participating in any or all of the following ways, which are non-exhaustive. One, by buying directly into the shares of the company listed on the SGX. The benefits are it is extremely easy to do and the returns can be very lucrative. However, considerations include the time spent to research and constantly monitor the news, watch the concentration risk, limited access to management, and the brokerage costs involved in trading. The second method is through exchange-traded funds or ETFs. These exchange-traded funds tracks the index, helping you to gain exposure to the performance of a particular index. This is passive investing, as the portfolio managers mimics the performance of the 30 constituents of the STI. The main advantage is cost, which is low compared to buying and selling multiple securities, and the convenience, which removes the necessity to monitor individual securities. One of the main disadvantages of ETF is the lack of active participation, as the portfolio managers do not invest into non-benchmark securities that can sometimes generate much superior returns compared to the constituents in the benchmark. The third method is through mutual funds, such as Amundi Singapore Dividend Growth Fund. This is a diversified open-ended fund where individual investors like yourself with limited time or resources can participate in the success of the Singapore growth story. Mutual funds are managed by dedicated professional managers who spend their time sourcing for investment ideas for their clients, and they seek to generate a higher return compared to the benchmark. This is the clear, distinct difference between mutual funds and ETFs. In addition, because the fund is a pool investment from all investors, it reduces concentration risk. What this means is that since individual investors with limited resources can only buy a handful of securities, by pooling, the fund is now much bigger, and hence the fund can own a well-diversified portfolio of securities, thereby removing a lot of volatility and generate a more consistent return over the medium to longer term.